Investors change their rate expectations. Welcome to Market Insight, I'm Ramzan Karmali. Well, the markets have reduced their bets on a bumper rate cut from the Fed next month. They now believe an 85% chance that there'll be a 25 basis point cut in November. So what's changed? Well, last week, September's payroll numbers came in a lot stronger than expected. But is the move warranted? Well, to help answer that, I'm joined by Aoifinn Devitt, Chief Market Strategist at Moneta. Aoifinn, thanks so much for joining us. Well, let's start with that obvious question. Are the markets right to believe that a 25 basis point cut in November is now the most likely scenario?
Definitely that would be our expectation. I wouldn't put too much confidence in market betting expectations at the moment. We can see they were quite profoundly wrong when it came to the jumbo rate cuts we've just seen, and a lot can change between now and then. Remember, we have the election between now and then, we have other polling between now and then, other favourites. A lot could change in terms of the market and sentiment. And already we're seeing a little bit of weakness today when we did have that very strong employment number. We do see strategists starting to poke holes in that number. Is it as strong as we actually think? Does it represent full-time or part-time employment? What really gets behind the numbers? And we say we're in a kind of a gig economy and not really in a normalised employment market. So can we take the confidence that we would typically take out of a number like that?
Well, looking at the data and looking at those non-farm payrolls, does it suggest perhaps that no cuts really needed if the US economy is in such sure footing?
I think that might be a little extreme. The Fed has been very good at telegraphing its intent. It's trying to eliminate the potential for surprise because it knows that markets abhor uncertainty and surprise. So I'd say that right now they're saying they're data dependent. They seem extremely confident that they've executed very well so far. They've executed and delivered a soft landing. So to have no rate cut would actually now surprise on the downside. And we're already looking at a very precarious market environment leading up to the election. There's going to be a potential for surprise after that. It would be surprising to say no rate cut. There would have to be some resounding reason not to.
Now, the US dollar is trading at a 7-week high at the moment. It had its best week since November 2022, just last week. How does this all play out for policymakers at the Fed?
I'd say that's more of a byproduct of the Fed policy more than something that drives them, because what we can see is that ever since we now think that the jumbo rate cut is not likely to happen in November, that rates will stay at a slightly higher normalised level. That's probably going to be solid for the dollar, and that's why we did not see the dollar continuing to fall. I'd say overall, election-wise, a strong dollar is good for the election and for both parties. It's a resounding sign of confidence in the US economy. Of course, it would be poor for exporters down the line, and probably it is too strong and needs to come down. But remember, what is the dollar strong relative to those other currencies, the euro, the sterling, yen? Neither of those has particularly strong fundamentals at the moment.
Aoifinn, you mentioned there the election. It's less than a month away. How do you think the presidential election is playing out in the markets at the moment?
It's interesting. So far, we haven't seen a lot of movement. We've had many data points, such as the debates. We've seen various opinion polls change around. It's an extremely tight election. And unfortunately, the reality is we may not even know the result on election night. We may have many weeks to wait. So that, of course, leads to more uncertainty brewing. And when it comes to the election outcome, though, it is pretty bifurcated. And I think markets already know that. If we have a Republican presidency, we're likely to immediately have more tariffs. We're likely to have much more of a protectionist approach in place that could be long-term and even short-term inflationary and could depress GDP, which is also likely to stir some dissent and perhaps uncertainty among trading partners. We also have some uncertainty around the tax outcome, depending on who prevails in the election. So I think rather than it being inconsequential, this election is actually extremely consequential when it comes to markets. The fact that markets are so calm in the run-up to them is somewhat surprising.
And next week, we've got some big earnings out. We've got the likes of JP Morgan, Wells Fargo, BlackRock, some big financial names there. What should we be looking out for?
It's interesting. There's a couple of many variables at play when it comes to financials earnings. Typically, financials do well with a high rate environment and don't do as well when rates start to come down. It's been turned on its head a little bit because we've seen that they have had some suffering times during the raising rate environment. And equally, they're now suggesting that expectations are too high, that all this strong economy is not going to play out in expectations. What actually, though, we have seen is that for the most part, earnings expectations have been extremely well managed. And we think that's across the board, not just financials. So we think that actually there is a good chance that many companies will surprise on the upside because expectations are not at all lofty going into this earnings season.
Aoifinn Devitt from Moneta, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.